This is Berkeley CMA video series. This is CMA part 2 and unit number 2 we are going to discuss. Unit name is financial ratios. Broadly we are going to discuss three types of ratios, which include the liquidity ratio, solvency and leverage, and in the last we are going to discuss the activity ratio to see the operational efficiency of the company. In liquidity ratios, we are going to check the short-term ability of a company to pay its obligations. In solvency ratio, opposite to that, we will check how the company is going to pay in the long run. Is it sustainable company? And in the operational activities, surely we are going to see how efficient they are in making sales, purchase, and how they are dealing with the operating cycle. First of all, we'll start now the liquidity ratio.
Is a mathematical term. Once you divide at least two things, it becomes a ratio. So, sometime if you are not feeling well, you will go to a doctor, right? The doctor will advise you with some tests. You will go to the lab, you will go for a test, then your report will come. It will say, okay, this is this much hemoglobin you have, this much your white cell, blood cell, this. So, this is a checkup which will result into some outcomes as ratios. Same way, when we want to check the companies, how fit they are, what is their performance, how healthy the company is. We use these testings called ratios, right? Sometimes you check your heart, liver is working proper or not. Same way we treat a company like a full man and we check each and everything, liquidity, gearing, activity, how they are performing. It's the same environment. Now, testing is always an easy thing. It's just require your analytical skills. Making something is difficult. You make Emirates Palace, it's difficult. But to say it's good or it's bad, it's very easy. Same way, financials, how to make it, how difficult this is, what was the situation, how difficult it was to run the business is okay. But to comment on this is very easy. But surely this easiness should have some formulas and should be systematic, scientific. It should not be, this company is a good company. Why? I don't know. This is my feeling. This is a big company. I feel this is a big company. It should be good. No, it's not like that. We have a system. We have techniques. These ratios we will discuss. This will check the company performance measures and how efficiently they are operating. What is their business cycle? What is their future growth? What is the how efficiently they are using their resources. Broadly, let me classify more in detail. Liquidity is the power to convert assets into cash. Most liquid the firm is like is a man who has more cash in his pocket. You can assume if you have no cash in your pocket, what will be the consequences? If you have big cash in your pocket, what would be the consequence? Surely everyone wants big cash. Same way, we have to first of all see what is the pocket of the company. Means how much short-term asset they have, which will convert into cash, and how quickly. This is the question. Because the electricity bill, heating bill, salaries, it comes every month, which has to be paid in cash. If you don't have cash, it will be a big problem. No matter you are a big company, you have invested billion of dollars, your plant is so beautiful, so huge, no one cares. They need electricity to run everything. Right? So cash is very important. That's why we will check. We will learn how to check the ability of a company to pay the short-term expenses. That we will check from liquidity. So we have certain liquidity ratios which will help us to see the short-term ability of a company to pay its expenses. And when we talk about short-term, so it's very clear that liquidity ratios will focus only on current assets and current liabilities. So let's start thinking that in income statement, in balance sheet, which items will be used in which kind of ratios. For example, if I want to calculate liquidity ratios, I don't need income statement because income statement has expense and income. I need current asset, I need current liabilities. So that's how we have to develop our skills. That first of all, check the short-term ability to pay the day-to-day expenses. If it is okay, then we can trust this company is good. For example, let's assume a domestic example. Some servant or maid comes to your home for cleaning or something. Once she enters, she looks around, she looks the sofas, the beds, and she assesses in her eyes. It's like a ratio analysis. She is doing in her mind that this family is able to pay or not. On her fixed date, she will ask the money. If you will give, she will satisfy. She will not think bad about you. But if you delay, she will assume your liquidity is not good. Same way, if your suppliers feel that this company don't pay on cash, on cash and on time, so they start reluctant dealing with you. Even telecommunication company, if you will not pay your bills 2 months, they will cut your line. And next time they will put some extra charges and they will bill you every month, and they will reduce your cycle as well to be a precaution. So that's why liquidity is the most important thing to see in a company, that either they are able to pay the short term, the expenses or not. For that, supplementally, we make a cash flow by direct method, which is only have inflows and outflows. Every month in companies, they want to see how much money they are going to receive, how much money they have to pay. So this is how they control. Now, next is opposite. First you check the short-term ability, now we have to check the long-term ability also to pay. Because it might happen that I have a credit card, I took some money from credit card which is 1 year sufficient for me. Suppose if my credit card limit is 100,000, I will take 75% of the amount. 75,000 dirhams is in my pocket. 1 year is sufficient. I'm paying interest, small amount, minimum payment, and money is with me. But after some time, this money will finish, and interest payment I have to pay. So you cannot only see how much pocket I have now. We have to see what is your condition in the long run. So that's why, and it's like a physician is, if you are saying that you have a problem in heart, so he is checking your liver, your other parts as well, that these parts are not affecting this part. Same way, when we are performing, we are checking the company's strength, financial and operational efficiency. We are going to have such kind of thing with us, that okay, let's check the liquidity, short-term ability to pay. Now, on the same hand, check the long-term ability to pay, that is called leverage or gearing, and supported by solvency. Solvency is from solvent, means this company will not close or has the ability to pay the debts, so it will not become insolvent, right? For that, we also need the long-term debts situation, liability part of the company. Then versus we need to know how much capital or equity is with us, how much is the liability. This we will learn the ratios. And last and very important is the activity ratio. This comes in operational parts of the company. We want to see how much good the purchase department is working, how much good the sales is working, how the inventory is handled, what is the operating cycle, means we buy from US, it comes to UAE, then we produce something, then we sell, and after selling we get money from the customer. This is all business cycle we have. So how efficiently we are doing it, this one? Means we pay in 30 days to the customer, the supplier, and we get money in 90 days from customer. So means 60 days net we have to invest our money into the business. So for that we check activities, day-to-day activities, sale, purchase, inventory, how much time we take to receive money from customer, how much time we take from supplier to pay his money. This is all efficiency ratios we are going to discuss in today's lecture.